Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. As the trade negotiation deadline of March 1st between the U.S. and China draws near, the markets continue to remain optimistic that a deal can be drawn before that timeline. In looking at the May soybean contract, we can see where the subsequent higher lows that we had long been talking about continue to hold well for the market, and we can see where a handful of marginal breaks had occurred, but the most recent break is going to be key because we're looking for the market to be able to recover back above this level if it is to make its way back up to the targets that we talked about before of retesting previous highs near 953. If the market's able to get back above our time price angle early next week, we would look for the potential of a market advance that tests somewhere in the neighborhood of 968 for the May soybean contract. In similar fashion, we're looking for key support to remain for the July contract near 920. And in doing so, what we'd be looking for is for the market to retest previous highs near 964.25, with the potential of making a move all the way up to about 980 in the coming weeks. Next week's key level of interest for the May contract sits at our 360-degree level of 926. And upon being able to get above this area next week, we anticipate that in advance that makes its way up to the 270-degree mark of 956.75, it would be possible for the May contract in the not too distant future. In similar fashion, we believe that the important level for the July contract next week sits at 944, which happens to be its point of control. And upon getting through this area, recent resistance that did live at 955 or the 270-degree mark, we believe would be cleared, paving the way for the market to make a potential run up to about 980. May corn has been range-bound for several months, and we can see where key resistance has been at 388.5 for the last couple of months. This is the level that we believe the market's going to need to clear, but it is evident from the way that the market's been trading that it has been trading inside of its low volatility period. That can be evidenced with our volatility bands narrowing inside for this contract as it's been making its way over the last several weeks. Once corn futures is able to break outside of its low volatility phase, it will then be able to migrate into its next key trend phase where we look for potential targets for the corn complex. Right now, we anticipate that an upside move is where we'll see a potential breakout, with the market finding resistance somewhere in the neighborhood of $4. Upon reaching the $4 mark, we do think that one more sell-off could very well be at hand, but for now, our anticipation is for the market to continue sideways with the possibility of making its way up to about the 400 to 405 level. As would be expected, the July contract is trading in a similar fashion. Its make or break level, although instead of being resistance as it had been for the May contract, has operated as the midline for where the market had been trading. By way of midline, that resistance overhead has been equidistant to support down below. We can also see, just like the May contract, where volatility bands have been narrowing, and the market needs to make a clear run away from its midline if it is to make it to our projected targets. For now, we're looking at the potential of a target upside of about 406 for the July contract, and upon hitting this area, we anticipate that the market would give us a significant correction from this point forward. The midline for the May contract has been at 386.5, and we can see where support has been at our 270-degree mark of 380.5. The upside target, as mentioned before, that we'd be looking for the May contract sits at about $4, and that happens to line up with our 180-degree mark as well. For a number of weeks, we had an upside projection for the wheat complex to make an advance up to about 543. But the market ran out of time and was not quite able to make it up there. In fact, the expiration for that time projection occurred about a week ago, and we previously had discussed where the market needed to clear the 78.6% area, or 524, for it to have a chance of making it up to that price objective. Instead, the market last week closed below that level, and in doing so confirmed for us that the market in all likelihood was going to have a retest of previous lows near 509.75. The market did just that over the past couple of days after breaking below that key 524 area, the market moved back up again, but instead of becoming support, found very good resistance there, and the May contract gave us two very big down days subsequently. The market has since broken previous lows, and we anticipate that the market can very well continue lower over the next couple of weeks with the potential to test somewhere in the neighborhood of 485 to 480. In similar fashion, the key level for the July contract sat at 529, and we can see where the market again failed to close above that area last week, gave us a retest of that level that became resistance, and the market gave us a very big down day over the last couple of days. The market, by the way, has posted for us an end band, but if the market's not able to recover over the next couple of days, what we anticipate is perhaps the market moving a bit sideways for about 3 to 5 trading days, at which point the market could then make its way back down, and for the July contract, we'd be looking for a test somewhere in the neighborhood of 490 to 495. A key observation for the May contract would be to look at the way the market responded after breaking below its point of control level of 531. The market had made a significant high back in December at about 540. It came back down, but that 531 level, or that point of control level, was persistent resistance over the last couple of months. What this tells us, or what this signals for us, is that there was perhaps a big seller at that level, and each time the market tried to make its way up at that level to break above, the sellers came back in. In fact, we'll notice that we had a time factor come in when that last major resistance occurred of January 24th. The sellers stepped back in and the market moved down. It consolidated a bit, moved back up to resistance near 531. That seller was not exhausted, and the market made its way back down again. In fact, we have another time factor coming in on February 13th for a potential turning point where the market made its way up into that level. It looks like the sellers stepped their orders down from the 531 level to about 529. And in doing so, the market responded much more dramatically, and we can see those huge 2 down days occur. And now we're looking at a potential price objective on the downside for this May contract that sits at about 490. If and when that market makes its way down, one standard deviation from that point of control level of about 490, we would then be looking for the market to collect itself, and if it's not able to hold support near 490 to 492, we could very well be looking at another leg to the downside. But for now, we're looking at 490 as a key area for the May contract, but we wanted to point out to you how these point of control levels play a key role in identifying for us in advance potential key support and resistance levels. In closing, we'll have a look at crude oil futures. Here we can see where the market for some time had been trading sideways, and we had been looking for a potential correction to come in to allow us a buying opportunity perhaps in the neighborhood of $48 to $49. Instead, this market appears a bit stronger than we anticipated. Instead, it found very good support at our 50% level of 54.42. In fact, this level happens to coincide with the point of control level of 53.80, at which point the market came in and only made a marginal recent low and has since been making its way up to our previous targets that sat at about 57 to 58. Our projection previously was for the market to come down perhaps to about $49 and to then give us another leg up to test somewhere in the neighborhood of 62.90, which is the make or break level for this contract. Instead, now we're seeing the market continue to make its way up from this level after breaking previous highs, and now the market stands to test volatility-based resistance overhead, and the next key level to watch for this contract would be at 58.84. Upon being able to clear here, we would anticipate that the market could very well make its way up to about 62.90. And if it were to clear 62.90 and not collapse from this point here, we could very well see a market that makes its way up about 1 or 2 standard deviations above its point of control near 71.90. The last thing we'd like to take a look at is the way in which this market has responded to our key 1-by-1 time price angle. That would be this red timing angle here, and over the last several weeks we can see that each time the market made its way near this area, it met it with very good resistance. The most recent time that we see, the market did make a nice move to the downside and has since recovered, and now we're testing that level once again. Upon being able to clear here, we do anticipate now that the upside resistance that we'd be looking at sits at about $60. And upon clearing 60, the next key area that we'd be looking for is the downside 1-by-1 angle overhead. These are going to be the key areas to monitor for the crude oil complex over the next week or two as the market looks to make its way up to that minimum price objective that we had talked about previously of about 57 to 58. Thank you so much for joining us for our regular market update. Look forward to touching base with you again next time.